Hello everyone, welcome back to the Road to Retiring channel. I hope you are doing well. I received a comment on my PayPal video from Jacob and he wanted us to go over Amazon, so that is what I am going to do today. If you enjoy these videos where I go over my values for stocks and my estimations on what the future prices could be, leave a like and subscribe and drop a comment to let me know any other stocks you'd be interested in me reviewing in the future. Now, starting on Amazon, I want to go through some of the slides in their presentation they released at the end of 2022 in quarter 4. Now their net sales was actually growing quite nicely, up 9% year over year, and what we can see is that AWS made up 16% of their net sales. Now this area of their business is growing really nicely, and this could be a major driver in revenue growth in the coming years and future. Now when we look at this segment's results specifically, we can see that they were up 20% in net sales in the AWS segment from quarter 4 of 2021 to quarter 4 of 2022. So we can see that there's that elevated growth in this segment, and I think there's a lot of room for future growth in this as well. But the issue is when we look at the operating income, it was actually down 2% year over year despite the 20% increase in net sales. We are going to need to see Amazon cut out some of the expenses attached when making sales through AWS so that we can see the operating income climb at a similar rate to these net sales. And if we see that, then I think we'll see AWS become the real powerhouse it could be in driving forward the price for Amazon stock. Now if you do wonder what AWS is, I'm going to go over it very quickly here. This is from Amazon's website, so it's obviously a little biased potentially, but it is cloud computing. It's everything to do with the world's most comprehensive and broadly adopted cloud platform. This is the leading cloud platform in its space. They claim it has the most functionality, the largest community of customers and partners, the most secure, and it has a really fast pace of innovation. And Amazon does have a real history of reinvesting a lot of their income and revenue back into the company to try and innovate it. So they do have a long history of this. So I want to go over the value of the stock and the metrics in a little bit of detail here. And as we can see, there's a lot of red here, and this EPS really should be red as well, because we can see that the EPS was growing really nicely up till 2021, but now in 2022 this is at minus $0.27 per share, and this is really not good. This makes the growth rates impossible to work out and is negatively impacting everything else, such as the return on invested capital. Historically they have levels above that 10% that we like to see, but because of the current net income and situation that Amazon find themselves in, this is falling into the negatives too. And obviously with the free cash flow in the negatives, we usually look at the free cash flow and long-term debt to see if they're going to be in any imminent financial trouble. And I think we're already past that stage. I think we're already in the financial trouble for Amazon. So because of this, we're going to be looking at quite a high margin of safety when we're looking at the value of the stock, as I do think that we're going to need something around that 25% mark instead of the standard 10% that we'd put in if something were to meet all of the attributes we'd like to see here. Now, going into the article quickly, I want to show you some of the thoughts on AWS, and Amazon CEO Andy Jassy actually spoke on Amazon's earnings call, and he said that most enterprises right now are acting cautiously and looking for ways to cost optimize, and he thinks AWS will continue to help customers with that. And he also believes that 90 to 95% of all IT spending remains on premises, and that over the next 10 to 15 years, the majority of this will shift to the cloud. So if you can imagine that, there is very, very large room for growth through the AWS sales, with 90 to 95% still needing to be moved over to the cloud. So if we do see something along those lines, then AWS could have a really, really aggressive drive for Amazon sales moving forward. Additionally to this, something else I thought was worth noting is that as they're currently in this uncertain economy, they have eliminated just over 18,000 jobs recently as a plan to reduce the costs because clearly they're not able to handle current costs with their net income being in the negatives, and they're hoping this will help them pursue long-term opportunities with a stronger cost structure, and they are optimistic that it's going to be okay moving forward. And I want to go into the analyst estimates for this. But looking at our sheet here, we can see that Amazon has an analyst 5-year estimated compound annual growth rate of 46%. Now obviously this is very, very high, but because we're moving from such low levels that were lower than before, you can see how this is just absolutely skyrocketing in the estimates, from $1.53 per share all the way up to $5.10. Now if we were to see those returns, it would be interesting to see how it impacts the buy value. I've gone with this 25% margin of safety and a 9.5% discount rate that I'd like to look for. And when we have this 46% earnings growth rate with a P multiple of 18, which is slightly above the sector median, because I do think Amazon will still pay a premium, but I'm just absolutely uncomfortable with the levels it's been at historically, trading around 60, 70 in the 100s. I'm not comfortable at those levels. I would expect a slight premium, and I think around that 18 mark is somewhere I'd feel comfortable. And if we have a look at what that means, if we do see a 46% earnings growth, that would bring the price over earnings fair value to $83.59. Now it's currently at $94.09 and 90 cents, sorry, but it wouldn't be a substantial drop to get there, only 11.92%, and that's with a 25% margin of safety. So the 2028 price would be a really nice return at $175.46. But if this earnings growth rate was slightly too ambitious and we were to lower this to say 30%, you can see how badly that impacts the buy value, bringing it down to a rate at around $98 for 2028, meaning that there would basically be no gains at all made in 5 years if it traded at an 18p multiple with 30% earnings growth. So definitely a lot to take in terms of Amazon and earnings growth rate. But I think the price over sales and the price over cash flow can maybe paint a better picture due to the state that Amazon find themselves in at the moment with the negative EPS. So looking at the price to sales, when we look at the revenue growth rate of 12.8%, which is in line with expectations, from 557 million up to 801 billion, sorry, not million, that's going to take us, from 557 to 800 billion on our model as well at that 12.8%. And I've gone for a price of a share multiple of 2. Now here I feel comfortable. It always sort of moves below and above those levels, and I feel like it averages out back to that level at 2 quite consistently. You can see this is going all the way back to 2010, and it's bouncing just above 2 to below 2, back up above 2, below 2, and then for a while, 2015 onwards, it was sitting quite considerably above 2, but right now it's dropped just down below that at 1.83, but I would feel comfortable around that 2 level, as it seems to head back towards it quite consistently. So with that price over sales multiple of $2, this would give us, and the revenue growth rate of 12.8%, this gives us a fair value based on the price over sales of $91.46. And that's including the 25% margin of safety. That would only be a 3.63% drop needed before the buy value starts to become really interesting based on this metric. And the 2028 price is really appealing at $191.97. This would be around a 100% return, so that would be absolutely fantastic. And based on the price to sales fair value calculation, if we were to see these revenue growth rates of 12.8%, Amazon could definitely be one that's worth getting into very soon based on the fair value being so close to current market price. Lastly, I wanted to look at the price over operating cash flow fair value calculation, because here's where things got a little bit interesting. If we look at their cash flow, it's made up largely by their depreciation, and this is what is eating away at lots of their current earnings, We look, their funds from operations, it's growing really nicely. From 2016 it was at 12 billion to 2022 at 67 billion. The funds from operations growing really nicely, but one major driver in this is the depreciation and amortization. We can see this went all the way up from 7.84 billion in 2016 up to 2022. Now when you're looking at the cash from operating activities, you do not have to minus off any depreciation and amortization from this cash from operating activities value, but when you're looking at earnings, you do. And this is one thing which is massively eating away at the earnings reports that Amazon are putting out. And so we do probably want to see this depreciation and amortization come down quite a lot, because right now it's just getting out of hand. And as you can see, the net income was moving quite nicely upwards until 2022, where it's fallen to minus 2.72 billion. So we're really going to need to see some of these things potentially change, because as I say, the depreciation is just getting a little bit out of hand. But when we look at the current value at around 46,750 for the operating cash flow, when we take that as the current value and we use an operating cash flow growth rate of 15%. Now this is slightly under what their historic growth rate is. You can see it was at 18.48% from 2015 to 2022. But this does include a drop. You can see in 2020 it was as high as 66 billion and fell to 46 billion in 2022. So based on a 15% growth rate, that gives a little bit of time to get back to those 66 billion levels in 2026, and then continue growing past that to 2028 at 87 billion. I think that's something as a reasonable expectation. We can't keep our usual similarities of operating cash flow growth rate just slightly above earnings, as obviously the earnings growth rate is absolutely through the roof, and because of this impact depreciation is having on both operating cash flow and earnings, it just means the relationship that's usually between earnings and cash flow just isn't there at the moment. So I've gone with an 18 price over operating cash flow multiple. If we look at the sector median, this trades at around 13 or 10, but Amazon's 5-year average sits at around 29.85. I do think Amazon will keep this premium with their price to cash flow ratio, because it is a company that people want to own, as it is so well known. The brand is so powerful, so it's a company that people definitely want to get into, and I do think it will hold its premium. And 18 is the sort of level where we see a lot of other stocks trade. I'm going to check Google. We're going to see 18 is the 5-year average for Google. If we look at something like Microsoft, this also trades at 22 as a price over cash flow currently, and their 5-year average is at 22 as well. So these sorts of levels are quite common amongst the really powerful stocks and the well-known stocks and brands that people want to own. But I feel comfortable with this price over operating cash flow multiple of 18, and based on that, with a 15% growth rate from the current values, that gives us a value and fair value for Amazon of $70.35 with a 2028 price of $147.67. So the price over operating cash flow calculation is coming out a little bit worse than the other two, with price to sales performing the best. I'd want to take sort of average between the three, because price over earnings and price over operating cash flow do paint quite a different picture to the price over sales, and I wouldn't feel super confident that that 46% growth rate is definitely going to be met. If that falls to say 35%, you can see how bad an impact that has. So this PE multiple could obviously trade higher. It could be somewhere like 24 with that 35%. So it's not the most easy thing to gather, but because the earnings are so low right now, if we don't have those high levels of earnings growth, this price over earnings fair value would just kill the rest. So across the three and the average, we're looking at a value of around $81 to want to get into this, but at the current market price, we would be seeing a 13% compound annual growth rate on your investment to that 2028 value. But we've got to be careful with this because of how high risk it is. We put on that 25% margin of safety. We want to be able to manage the risk. And I think around that $81 fair value is where I would become interested in Amazon, because it's just too much of a grey area at the moment with this negative EPS, and I'd love to see that sort of turn the corner a little bit before I personally get back in. I'd love to know your thoughts on Amazon and any other stocks that you want to hear about and talk about in the future on this channel. And now, it's been Road to Retiring. I'll catch you all in the next one. Bye guys.